All right, a major downturn is expected in commercial real estate in the next few years.
There's $3.5 trillion worth of commercial real estate debt in the United States, of which $1.7 trillion is on the books of community, regional, and sub-regional banks.
Practically every commercial real property in the country, in every major city, office buildings, apartment buildings, shopping centers, hospitality, was refinanced 05 to 08 on relatively short terms. Those loans are now coming due.
Housing tracts, condominium projects, apartment projects, office buildings, strip malls, malls, all of those sorts of things are commercial lending.
Commercial loans are much shorter than mortgages, usually lasting 5 to 10 years, and the full amount must be paid off at the end of that term.
We're looking at more than half of the loans actually rotating within 5 years. So the bulk of the commercial market is turning over.
Worldwide Plaza, 1.6 million square feet of prime midtown office space.
And this building was priced around $1.7 billion.
Great recession, sky-high unemployment, a glut of office space, so rents fell, building values too. Meanwhile, the short-term one-year mortgage for Worldwide Plaza came due. Owner can't refinance, the lenders take over. Resale price?
Just traded about a month ago for just under $600 million.
Wait, it sold 2 years ago for $1.7 billion and now for $600 million?
Yes.
And the problem is going to get really bad in 2010. And the reason it's going to get really bad in 2010 is that underwriting standards departed from reality beginning in 2005. And that continued 2006 and 2007. The 5-year loans come home to roost in 2010, 2011, and 2012.
The values at which these properties were refinanced 05 to 08 are far in excess of what they could be refinanced for now. Most of these properties are financed with complex debt stacks. So what happens is we have junior loans, or what we call mezzanine loans, behind the first mortgages, sometimes as much as or as many as 10 mezzanine loans on a single property or portfolio. The problem is that oftentimes the junior lenders and the equity will be willing to invest some significant additional capital to salvage their investments. The problem is that the first mortgage, which is of course in the catbird seat when the maturity hits, if they're not willing to write their first mortgage down to the current value of the property, it makes no economic sense for the junior lenders or the equity to put in the money. So if you have a property with a $500 million previous value and a $400 million loan, first mortgage loan, that now has a $200 million value, the junior mezzanine lenders and the equity are never going to invest. And what's happening is these TARP banks, these TARP subsidized banks, are not writing down those first mortgages, and they're not booking those losses. They're extending and pretending they're taking it in on foreclosure and keeping the loan on the books.
And White's data suggests that the $3.5 trillion in outstanding commercial real estate debt could be what some fear. The other shoe about to drop.
Many of the banks have been very willing to extend loans and delay the problem, and hopefully by extending the market will rebound before they actually have to realize those losses.
How many defaults are you anticipating? How big of a crisis could it potentially be?
Well, I think that it could bring down more than 500 regional, sub-regional, and community banks in the next 12 months alone. And it is only the fact that their mortgages, their commercial mortgages, are not marked to market, but we're waiting for the maturity defaults to occur, that things haven't happened sooner. In addition, the government does not want to meet a problem halfway. If you saw the FDIC, they talked about this week how their funds are now getting low. Their insurance funds are getting low.
Right.
So they don't want the problem to happen before they have time to rebuild some of the funds in their deposit insurance.